I want to be the guy that make it easy for all of you. Here's the one hit wonder. This is it. This is all you have to do. Do this, and you'll be able to make money all the time and not lose any money, and that would be great. And I wouldn't monetize it. I would give it away for free. I promise. I swear to God Almighty, if I had one thing that simply worked one way, only had to do this one thing, it would be given to you for free by me. But practically, that doesn't exist. Realistically, it can't be obtained because all of us have our own individual quirky characteristics, their own personality, and you have character flaws. All of us do. And you have to limit your exposure to these markets because they're Rorschachs, they're ink blots. You're going to see what you want them to show you. You're going to read into these candlesticks whatever you want to see happen. Now, if you're anticipating things with a logical, rule-based idea based on statistical probabilities and things that have occurred in the past, and that's your reason for doing it, then okay, fine. Then I agree with you looking at that ink blot that these characters line up in forms of candlesticks. We see a narrative in there versus, well, if it does this, then I'll do that. That's reacting. We're not reacting to price. We're anticipating it. So in New York session, whether you're a Forex trader trading between 7 o'clock and 10 o'clock in the morning New York local time, or if you're an index trader trading anywhere between as early as 7 o'clock in the morning all the way up to 11 o'clock, you don't want to take any new setups after 11. You don't know what you don't know yet. You don't know what impact certain things are going to be for you as a student. You don't know what it's going to be like when you find your model. It's going to be something completely diametrically opposed to what you thought trading was all about. You find your profitable model and you're consistently finding setups, and you're going to look back and say, I didn't know anything. Look what I'm able to do. And this is what I'm doing. This is all I have to do. If I just live and bloom right where I'm planted, I'll do whatever I need to do, monetized 5 handles consistently. Every setup that you look for, if you just find 5 handles that nets you that minimum, you don't need to do any more than that. You literally can carve out independent wealth. And that is defined by however you want to define it. Whatever dollar amount, given enough time, compound interest will allow you to get there. But you can't do that if you're jumping around trading in the New York session, London session, afternoon session, PM session. You're just trying to get in and do everything. No. Back test all those sessions. Yes. Actively trade and anticipate your setup in every single one of them. No. The only thing you're doing is compounding the likelihood of failure, losing trades, and drawdown. And you're new. What are you going to do when you have drawdown? You're going to want to fix it real quick because a Band-Aid ain't going to work for you. What's a Band-Aid? Take the boo-boo, limit it, cover your loss, cover your little cut, your paper cut, cover it up, and walk away and let time do the healing. That means don't take any more trades. That's hard to do, isn't it? But you don't understand. I gotta go look at myself in the mirror, ICT. I did something I knew I should have done. I gotta fix it. You're not in the right state of mind to fix it. And you're gonna look at these next sessions, like I'm covering here in the same trading day, and think that you're gonna have the skill set while you're in drawdown mentally. We're not talking about the mental, not the mental, but the financial aspects of what drawdown you may have incurred. You're in mental drawdown. You're now a dangerous wild animal. And you're going to turn yourself loose to your money, to your account. A caged animal, a cornered animal, poked and prodded, now made aggressive. That's what you are. You're aggressively trying to take back what somebody or something or the market took from you when you did it to yourself. The Band-Aid approach is the right way. Limit it, stop the bleeding, come back when you're ready to do it again. But not the same session. That's how a brand new trader should do it. Not, I got to fix it right now. No, you don't. Who said you had to? You, the wounded animal, saying that. You're home. You're safe. You're in a position where you can't lose any more money. You are out of the market. You've been stopped out or squeezed out. You're done. The damage is done. Stop the bleeding, put a Band-Aid on it, and come back when it heals. Put one sleep between your drawdown and your next trade. Use that as a rule-based idea. Let yourself go to bed and sleep a whole night before you take another trade. It's hard, but you desensitize yourself. The New York session is a continuation of whatever London is. So if London was going down and it has not reached your higher time frame daily or weekly objective, we expect some measure of short-term retracement and then continuation in the New York session until the higher time frame weekly or daily objective that we would be reaching for as a draw on liquidity, the target. When that's hit in the New York session, then you are entering New York reversal profile, not market profile where they have the vertical volume bars, going horizontally across the chart. That to me, I don't use that stuff. When I say profile, that's like a schematic or a roadmap or a visual representation of how the market should perform if you were looking at it from like a line chart basis, how it should look after the fact. But we're anticipating it to perform or behave a specific way. So New York session's continuation of London, and then New York goes into market reversal profile, where whatever happened in London in the early stages of New York now reverse, and the market goes a different direction. Whether if it's going lower, now it will go higher, or if it's going higher, it will now go lower. If and when it hits the weekly or daily objective that we were aiming for, that framed our bias or premise behind our trading week. Silver bullet inside of the AM session. That time window is very, very specific. It's inside of 60 minutes. Now, that doesn't mean the entire trade is encapsulated inside that 60 minutes, but most of the time you're going to find it is. But you can find the entry in between 10 o'clock and 11, and all you're looking for is a continuation of what London and or New York is outlining. So we have a target. We're looking for a draw on liquidity. It could be a new week opening gap that we're aiming for. It could be a fair value gap above the marketplace that we're aiming for if we're bullish. And that draw on liquidity is what we're looking for, a reach from that fair value gap that forms, whatever the fair value gap, the first one that forms between 10 o'clock and 11, that one, you're going to see that right there, that's going to be a catalyst for a minimum 5-handle run. I'm teaching independence from everything else except for open, high, low, and close and time. The lunch hour, the New York lunch hour is technically 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. So it's a 2-hour window. As an example, let's assume that we've watched the market go higher in London, and then we had a continuation in New York. And whatever the target is that we had for our weekly chart or our daily chart has yet to be reached. So we're still below it. Your expectation for the lunch hour between 11 o'clock and 1 is you want to go through and look for where a relative equal low or a 15-minute low is, because that's exactly where the algorithm is going to go. And you're buying those sell stops. As it runs underneath it, you're buying it. What makes it better? If there's a fair value gap or a volume imbalance just underneath that low, that right there is a unicorn. Why is it going to go down there? Because it's going to pick up more orders to allow smart money. You're a trader with a religion. You were a dealer. They called a market maker. I'm talking about the mechanism that is the market that was coded and brought to us as a price engine that causes the fluctuations in price. And then you chase it. Other traders, they chase it. They go in there, buy and sell after it. It will use that human psychology to know that there will be trades printed at the levels they want. When the algorithm's running, it's not going to go to some random level. It always goes to something that I've taught you as a PD array. It's always like that. In lunch hour, that 15-minute low, when it's been bullish and we haven't hit that weekly or daily objective, it's going to roll down there. It's going to go right below that low. And it's going to engage those sell stops. And the market's going to be flooded with willing sellers at a low price. Why, pray tell, would that be advantageous? Because smart money will be buying those sell stops to reaccumulate new longs, add to or start new positions, and wait for that higher time frame, weekly or daily chart objective to be met. And then you'll watch the PM session roll through and reach higher to that target or get closer to it ever so slightly. That's that liquidity matrix. Understanding where you are in it. You have to know where the market's going to go. That's the first rule of Fight Club here. You have to know, where is it going? You have to know that. If you don't know that, everything else afterwards, you're lost. If you don't know where you are going, where the market's being led to, it's an obvious level. It's in your chart. And that's what I'm sharing my experience with. I'm pointing to those things. I'm hoping that you're aligning yourself with, okay, I'm going to submit this studying price delivery in the basis of it's going there, and filter out all the things that would be opposing that as an idea in terms of trades, accepting the fact that there will be fluctuations that you didn't participate in. That's okay. That's discipline. That's you sticking with a rule-based idea, and you're keeping your focus on what is the highest probable direction. The market goes up and down, folks, up and down, up and down. But where it's going to ultimately, once it gets there, then you can look back and say, wow, yeah, I can see how it was obvious there. But I'm teaching you how to see the obvious real time. It's not easy for some of you. Others, it is. But most of you are going to find that it's very hard to do that because you want it to be easy. And I want to be able to make it easy for you. There is no other way to make it easier. You have to go through it. You have to condition yourself. You have to look for it to repeat over and over again within specific times of the day. So between 11 o'clock and 1 o'clock in New York local time, you're looking for a run on stops. What stops? The stops that have not been hit, and punishing those individuals that may have trailed their stop loss up below an old low or down below an old high. If you're bullish and it's been going up, a 15-minute low underneath that, that's sell stops. It's going to run down there, take those, and then you're going to see it trade higher. Even if it fails and just goes to a higher high and never continues after that, that's still tradable. But some of you would think that that's a failure. It didn't keep going up to my target on a higher time frame chart, ICT, so that's a failure. Wrong. Could you get 5 handles out of it? And did you take 5 handles? That's how you start. That's how you build yourself up. That's how you grow. And eventually you do that enough and you start seeing setups that you know you've been here before. Yeah, I can get my 5, but let me take 5 off with half the position and leave a runner. And then you graduate to becoming a 10 handle trader. And you do the same thing for a little while. Let that build up. And then you start seeing, this looks like it's one of those setups that gives me a 25, 30 handle run. Let me take off half at 10 and then leave a runner on. And then you start growing into being a 25 or 30 handle trader. If you have a trade and you take a losing trade, then you lose and you take another trade and then you lose and you take a third trade. Now you're down maybe 5%. Now you have analysis paralysis. You second guess everything. And now you know that looks like something you would have traded, but I don't really want to take it. I'm scared. Let's just see if it works. Then it works and you're thinking, oh man, I should have took that trade. Why didn't I take that trade? Because you have not grown in learning how to do this properly, and you traded too much. You lost too much because 5% is too much for a new trader. You pushed yourself too far. So you have to let time heal it. That means take a week off. You're the problem. You're impatient, you're impulsive, and you're reckless. And that can't be fixed by me. It can't be fixed by any other educator. And no product is going to fix it. No resource. No black box. No mentorships. No, none of that stuff is going to fix that because you have a problem. And that has to be corrected by you over time, going back to square one.